Good morning. Welcome to the Alberta Securities Commission 2026 Corporate Finance Disclosure Information Session. I'm Denise Weirs, the Director of Corporate Finance here at the Alberta Securities Commission. This morning, we're going to provide some highlights resulting from the disclosure reviews conducted by a corporate disclosure and financial analysis team and some regulatory updates. There's further details in the report that we published on November 27th, available on our website on those the results of those reviews and the regulatory updates. Before we move on, I wanted to mention that we also have another session next week, November 29th, same time, that will report on the results of our disclosure reviews focused on oil and gas reserves and resources disclosure, as well as some financing statistics with respect to the energy sector and the results of our sustainability reviews. I'd like to just to provide the land acknowledgement now. As you know, Alberta is the traditional and ancestral territory of many peoples, including the Métis people, the Inuit people, the First Nations presently subject to Treaties 6, 7, and 8, and we'd like to acknowledge their histories. We respect their languages and cultures of the various First Peoples of Canada who've lived and cared on these lands for generations and whose presence continues to enrich our communities. I'm going to pass it over now to Jennifer Pearson, who will provide sort of an overview of the agenda for today and kick us off with some of the insights. Jennifer is the individual who's really stick-handled putting together the report this year and coordinating our efforts for the webinar. And I'll be back at the end of the session as we move into the Q&A. So thank you and see you in a bit.
Thanks, Denise, and good morning, everyone. My name is Jennifer Pearson, and I'm joined by my colleagues Chelsea Holsworth, Vernon Cooney, Nicole Law, Tanya Fleming, Oliver Lucian, and Anthony Potter. We're members of the Corporate Finance Division, and we conduct disclosure reviews, including continuous disclosure reviews, as part of the Alberta Securities Commission's Disclosure Review Program. Today's discussion is intended to share insights into areas that we've identified in our reviews and dealings with issuers that we think might be of assistance to issuers, and share some updates on regulatory developments. In particular, we'll highlight areas where current events and economic uncertainty should be addressed in continuous disclosure, draw attention to disclosure issues concerning material contracts and related party transactions, describe the requirements and procedures to obtain a management cease trade order, discuss the proposed pilot project allowing eligible venture issuers to adopt semi-annual financial reporting, explain the listed issuer financing exemption and recent amendments that have come into effect, provide certain corporate finance regulatory updates, and discuss the proposed multilateral instrument 45111 self-certified investor prospectus exemption. Before we get started, if you could please note the following disclaimers. Additionally, please note that we will answer questions at the end of the presentation using Slido. We'll attempt to answer as many questions as possible, but in the event we are unable to get to your question, if you provide your email address when submitting your inquiry, we'll get back to you. Alternatively, you can reach out to us after the presentation. Our contact information will be provided at the end. This session is eligible for Certified Professional Development, also referred to as CPD hours, for CPAs. Other professional bodies may also accept this session for CPD credit. Please follow up with your relevant institution to make this determination. To receive confirmation of your attendance at this session, you must enter the codes presented in the survey at the end of the presentation. Half an hour of CPD credit will be provided for each correct code, so please ensure that you write down the codes as they are displayed. As our first topic this morning, I'm going to discuss disclosure considerations regarding current events and economic uncertainty. Canadian reporting issuers are currently facing several significant challenges shaped by global and domestic events, including geopolitical instability, evolving trade policies, commodity price movements, and business interruptions. These evolving conditions have increased uncertainty in financial reporting, placing greater emphasis on providing complete disclosure and regulatory filings so investors can assess their impact. To help reporting issuers understand their obligations in this regard, we felt it would be useful to outline where in continuous disclosure these types of events and their potential implications should be considered and addressed, and discuss the types of disclosure staff would expect to be provided. Although disclosure may be required in several different continuous disclosure documents, much of this disclosure will be required in the MD&A. In accordance with sections 1.2 and 1.4 of Form 51102F1, the MD&A must include a detailed discussion of known trends, demands, commitments, events, or uncertainties that have or are reasonably likely to have an effect on a reporting issuer's business. This includes any current business or global issues that have or will potentially materially impact them. For instance, those issuers that have been or are likely to be affected by the implementation of trade protectionism policies, including the imposition of significant tariffs by other countries, should discuss the details and the expected impacts on their business in their MD&A. Impacts to the business may include increased costs, reduced competitiveness, and in some cases, the loss of an export market. And while some industries are partially shielded by lower tariffs at the moment, uncertainty about tariffs may lead issuers to delay projects and investments. If this is the case, staff would expect disclosure in the MD&A to reflect this. It's important to note that when preparing the MD&A, all information available up to the date of the document should be considered. Reporting issuers must disclose the risks associated with their business in their MD&A and their AIF if they have one. Risk disclosure should be tailored to the reporting issuer's particular circumstances and clearly articulate the potential effects on the business. To ensure that risk disclosure is complete, reporting issuers will need to consider current events that might impact their business. For instance, if an issuer has operations in a region where geopolitical tensions have recently developed or intensified, they should disclose this fact along with any related material risks and potential effects to their business. Such risks might involve trade route or supply chain disruptions, exposure to currency volatility, government interference, or asset seizure, among others. These risks might result in lower sales, increasing expenses, growing regulatory burden, impaired assets, or other consequences. As conditions evolve, reporting issuers should regularly review and update their risk factors as necessary to reflect material developments. Reporting issuers are required to provide an analysis in their MD&A regarding their capital resources and their ability to generate sufficient cash to meet their operating needs and any planned growth or development. To provide investors with a full understanding of the company's financial circumstances, this disclosure should include a discussion of current trends that may impact the business. For example, if a reporting issuer operates in an industry where commodity prices can fluctuate substantially, they should discuss the impact those fluctuations might have on their liquidity and capital resources. If a company is involved in hedging commodity prices, staff would also expect these activities to be described. Other matters that should be included in an issuer's analysis are situations where payment terms have been altered, restrictions exist on the transfer of funds, and a default occurs or a significant risk of default has developed. Economic and other events may cause or be expected to cause actual results to differ materially from previously disclosed material forward-looking information, or FLI. When events occur that are reasonably likely to cause results to materially differ for a period that is not yet complete, reporting issuers are required to provide an update in the MD&A or in a news release. Disclosure should include a discussion of the events and circumstances that occurred in the period and the expected differences. For example, if a reporting issuer disclosed that their new plant would be operational in 2 years, but applicable permits have since been materially delayed due to a change in government policy, the issuer should provide an update on the FLI in their MD&A, explaining the delay and how it will impact their timeline, costs, and next steps. When actual results are available regarding a previously disclosed financial outlook or forecast presented in the form of a historical statement of financial position, statement of comprehensive income, or statement of cash flows, a reporting issuer must disclose and discuss in its MD&A the material differences between them. For example, if an issuer previously disclosed forecasted revenue from the operation of a new plant, when actual revenue is known, the issuer must compare it to the previously disclosed forecasted revenue and explain any material differences or variances. With evolving economic uncertainty, some reporting issuers have opted to limit or withhold FLI, including prospective information about financial performance, financial position, or cash flows. However, as previously indicated, the MD&A must include disclosure regarding known trends, events, and uncertainties that are reasonably likely to affect a reporting issuer's business, even in the absence of specific financial forecasts. It should also be noted that if an issuer chooses to withdraw previously disclosed FLI, they must disclose this decision in their MD&A and discuss the events and circumstances that led them to make this decision. The issuer must also discuss any assumptions underlying the previously disclosed FLI that are no longer valid. During times of uncertainty, issuers may want to provide supplemental financial information to help investors distinguish between temporary and permanent financial impacts. If issuers choose to disclose this type of financial information in their MD&A or other disclosure documents, they must ensure that their disclosure is not misleading and that it complies with National Instrument 52-112, non-GAAP, and other financial measures disclosure. For instance, in the required reconciliation of a specified financial measure to the closest measure disclosed in the primary financial statements, it would generally not be appropriate to describe a reconciling item as non-recurring, infrequent, or unusual, or use a similar term if a loss or gain of a similar nature is reasonably likely to occur within the next 2 financial years or has occurred in the prior 2 years. Additionally, it would not be reasonable to remove an item simply because it's currently unfavorable. For example, if an issuer has financial instruments that are recorded at fair market value, it would be misleading to remove related losses in determining a specified financial measure if gains were included in the past. It should be noted that if an issuer changes the composition of a previously disclosed non-GAAP measure, National Instrument 52-112 requires that they disclose this fact and explain the reason for the change. Several accounting estimates may be impacted by current events and economic uncertainty, including those related to provisions, contingencies, and impairments, among others. Where a non-venture issuer is required to make assumptions about matters that are highly uncertain, pursuant to item 1.12 of Form 51-102-F1, they are required to provide information in the MD&A about how the accounting estimates were made, how they might change, and how they will impact a reporting issuer's financial position. To fully address the requirement, non-venture reporting issuers should discuss the methodology used and the assumptions applied in making its critical accounting estimates and describe how their accounting estimates might vary as circumstances change and develop. For example, where an issuer performs an impairment test, they should provide disclosure about how the recoverable amount was determined. If the reporting issuer indicated that they applied the value in use method to determine the recoverable amount, as outlined in IAS 36, material information for investors could include how cash flow projections were determined, including what significant assumptions were applied, how the rate of decline or growth was estimated, and how the discount rate was selected. A sensitivity analysis and discussion about how the recovery amount would have been impacted if key assumptions were changed should also be disclosed. It should be noted that this section of the MD&A should enhance and complement a reporting issuer's financial statement accounting policy disclosure, rather than simply restate it. It should also be noted that any changes made to critical accounting estimates during the past 2 financial years must be disclosed in the MD&A. In accordance with International Accounting Standard 1, presentation of financial statements, when preparing financial statements, management is required to assess a reporting issuer's ability to continue as a going concern. In making this assessment, all available information about the future, for at least 12 months from the end of the reporting period, must be taken into account. and if management is aware of material uncertainties related to events or conditions that may cast significant doubt upon the reporting issuer's ability to continue as a going concern, those uncertainties must be disclosed. Material uncertainties might involve recurring losses, a working capital deficiency, covenant breaches, a decline in commodity prices to a point where their revenues do not cover their costs, and or the announcement of a new tariff that will negatively impact their business. Even when management determines that there is no material uncertainty regarding a reporting issuer's ability to continue as a going concern, disclosure is still warranted if significant judgment was involved in reaching that conclusion. In such cases, management will be required to disclose the key judgments that were made and any mitigating actions that were judged sufficient to make the going concern determination appropriate. Mitigating factors might include obtaining a waiver for a debt covenant breach, the deferral of a loan repayment, completing a financing, and or applicable commodity prices are forecast to improve. Additional disclosure that provides further insight into management's conclusion regarding the ability of the reporting issuer to continue as a going concern in light of uncertainties should be included in the MD&A pursuant to item 1.2 of Form 51102F1. There are several other additional areas that may be affected by increased economic uncertainty, including revenue recognition, expected credit losses, compliance with debt covenants, impairment of non-financial assets, financial instrument valuation, events after the reporting period, and material change reporting. Please note that the matters I've discussed are not exhaustive. Reporting issuers should focus on providing disclosures that are material and relevant to their specific circumstances and ensure that all material impacts of the economic environment are appropriately addressed in their continuous disclosure. That concludes my presentation. Now I'll hand it over to Chelsea to discuss the next topic. Chelsea.
Thanks, Jennifer. My name is Chelsea Halsworth, and I will be discussing material contracts and related party transactions. During the course of our CD reviews, we regularly raise comments on these two topics, and hopefully you'll find our discussion as a helpful reminder of the disclosure requirements. We'll begin with material contracts. In today's discussion of material contracts, we're going to go through the types of documents that are required to be filed, as well as the filing deadlines set out in National Instrument 51102, Continuous Disclosure Obligations. We will then discuss the areas where we commonly see disclosure deficiencies with respect to material contracts, and provide some practical tips to help ensure compliance with this section. As a reminder, material contract disclosure requirements are included in Section 12 of National Instrument 51102. The first type of documents that are required to be filed are referred to as documents affecting the rights of security holders. These are the articles of incorporation, amalgamation, continuation, or any other establishing or constating documents of the issuer. These are only required to be filed once unless there are changes, which would require the updated documents to also be filed. Documents affecting security holders also include bylaws or other instruments currently in effect, security holder or voting trust agreements that would be regarded as material to an investor, as well as any security holders' rights, poison pill, or similar plans. Finally, if there are any other contracts of the reporting issuer or a subsidiary of the reporting issuer that create or can reasonably be regarded as materially affecting the rights or obligations of its security holders, those must also be filed. The second type of documents required to be filed are other material contracts. A contract is considered material if a reasonable investor would consider it important in making an investment decision. Examples of material contracts include debt agreements, merger and acquisition agreements, and licensing deals. An exemption exists in National Instrument 51102 that allows an issuer to not file a material contract if it was entered into in the ordinary course of business. To determine what is considered the ordinary course of business, staff would assess the issuer's business operations and industry. However, this exemption is not always available, and there are some instances where contracts entered into in the ordinary course of business are still required to be filed. Those include contracts other than employment contracts in which directors, officers, or promoters are parties. If a contract is entered into in the ordinary course of business to sell the majority of the issuer's products or services, or to purchase the majority of the issuer's requirements of goods, services, or raw materials, those must also be filed. Any franchise, license, or other agreement to use a patent, formula, trade secret, process, or trade name are also required to be filed. Issuers must file financing or credit agreements with terms that have a direct correlation with anticipated cash distributions. In addition, if the issuer has entered into contracts to have certain of its management functions provided by external parties, those external management or external administration agreements must also be filed. Lastly, if the issuer's business is substantially dependent on a specific contract, that contract would be required to be filed, even if it was entered into in the ordinary course of business. It's important for issuers to file material contracts promptly on SEDAR+, as these documents provide investors with an understanding of the business and the potential effect that the material contract has on operations. The documents affecting the security holders and material contracts must be filed no later than the time the reporting issuer's annual information form, or AIF, is filed. In the case of issuers who are not required to file an AIF, the documents must be filed within 120 days after the end of the issuer's most recently completed financial year. Disclosure of material contracts is required in a prospectus, should one be filed, and in a material change report, if the making of a material contract is considered a material change for the issuer. If an issuer files an annual information form, a list of material contracts must also be included in that document. In the AIF, the issuer must disclose details of the material contracts, including dates, parties, consideration provided for, general nature of the agreement, and the key terms. We often see inconsistencies between the contracts an issuer has identified as material in the AIF compared to those actually filed on SEDAR+. For example, we have seen instances where contracts were not determined to be material at the time they were entered into, but then when the AIF was prepared, it was listed as a material contract. Another major source of judgment in terms of determining what contracts are required to be filed is considering what is the ordinary course of business, and if any of the mandatory filing requirements in Section 12.2 would still require the contract to be filed. In many of our reviews, the nature of the issuer's business is such that they are substantially dependent on a particular contract, and consequently the issuer is required under Section 12.2 to file the contract regardless of the fact that it is part of its ordinary business. Another area where we see issues with material contracts are the redactions that an issuer makes when filing the material contract. Under subsection 12.23 of National Instrument 51-102, an issuer may, in some specified cases, omit or redact a provision of a material contract that is required to be filed if an executive officer of the issuer has reasonable grounds to believe that the disclosure of the omitted or redacted information would violate a confidentiality provision. When information is omitted or redacted, a description of the type of information that is omitted or redacted has to be provided. We often see this disclosure missing. Sometimes we come across instances where the information that has been omitted or redacted is not appropriate. For example, it is inappropriate for an issuer to redact references to the acquired assets from a material asset purchase agreement or the terms of a debt covenant, as this information is necessary to understand the impact of the contract on the issuer's business. In cases where we see inappropriately redacted information, we'll ask the issuer to revise the contract and refile it on SEDAR+. Some practical tips to ensure all material contracts are disclosed and filed are: keep a list of contracts entered into and include key terms, parties, duration, termination rights, and financial impacts of each contract. Maintaining a formal internal policy or checklist for assessing materiality that has been assessed by legal counsel is also helpful. For each new contract entered into, issuers will need to determine right away if it meets the materiality threshold, requiring it to be filed as a material contract. Issuers will also want to revisit this in connection with the preparation of their annual filings to consider whether the materiality assessment has changed. As a reminder, materiality should not just be based on quantitative factors. qualitative factors must also be considered. Ensure that the material contract is filed in a timely manner on CDAR Plus, and if there are any redactions or omissions in the contract, ensure that they are appropriately explained. The second topic I'm going to cover today is related party transactions. This continues to be a hot topic area, as we often see issues arise from missing or incomplete disclosure of transactions involving related parties. Today, our discussion is going to be on the continuous disclosure requirements for related party transactions set out in National Instrument 51-102. We're also going to talk about the common deficiencies we're seeing and how to address them. Lastly, we're going to touch on additional disclosures that may be required for related party transactions that fall within the scope of Multilateral Instrument 61-101, Protection of Minority Security Holders in Special Transactions. We're back in National Instrument 51-102. However, this time we're looking at Section 1.9 of Form 51-102F1, Management's Discussion and Analysis, where the disclosure requirements for related party transactions are explained. Additional disclosures are also required in the financial statements pursuant to IAS 24 related party disclosures. There are also disclosures required in the annual information form, if one is filed, about material interests of management and others in material transactions that have occurred within the 3 most recently completed financial years. With the disclosures in these 3 documents, a reader should be able to fully understand the related party transaction. Specifically, the disclosures required include identifying the related party and the recorded amount of the transaction, including the measurement basis used to determine the amounts, such as the purchase price. It is also necessary to disclose the business purpose of the transaction and economic substance. A description of any ongoing contractual or other commitments that arise as a result of the transaction must also be disclosed. And finally, any other additional information that the issuer determines is necessary to understand the business purpose and economic substance of the transaction, including the financial interests of related parties in the transaction, and cross-ownership of financial interests, if applicable, must also be disclosed. Comprehensive disclosure of related party transactions is important as it highlights the influence relationships can have over a transaction and the financial results of an issuer. A related party transaction could have special terms, conditions, or advantages due to the nature of the relationship between 2 parties, making it even more important to ensure that robust disclosures are provided. Between the information provided in the financial statements and MD&A, readers should have a clear understanding of the transaction and parties involved. However, we often find that this is not the case. In many instances where we raise comments about a particular transaction, we obtain more information that is required to be disclosed because the transaction was not identified as a related party transaction, or it was, but there's missing material information. Oftentimes, we ask issuers to clarify disclosure in future filings regarding related party transactions, but we have also asked issuers to refile financial statements or MD&A in order to add additional disclosure about the transaction. Another common issue we see is the financial statement disclosure repeated again in the MD&A. While the disclosures required by IAS 24 related parties is similar to the disclosure requirements in Section 1.9 of Form 51-102F1, repeating disclosures is not appropriate or sufficient. Additional disclosure is required in the MD&A, identifying the related parties and the relationship between the issuer and the related parties. This disclosure should be in enough detail so that a reader can understand who the related parties are, whether they are individuals or entities, and what their relationship to the issuer is. Often we see disclosure using general titles. However, naming the person or entity is what staff generally expect to be disclosed. The MD&A form also provides that an explanation of the recorded amount and measurement basis must also be provided, as well as the business purpose of the transaction. A description of any ongoing contractual or other commitments is also required. While these disclosures are similar to those provided in the financial statements, the MD&A is meant to expand on financial statement disclosure and should include additional details that may not have been included in the financial statements. Another common deficiency we see is missing disclosures required by Multilateral Instrument, or MI 61101, protection of minority security holders in special transactions, which leads me to my next slide. What is MI 61101 and when are these additional disclosures required? There are many types of transactions that could fall within the scope of MI 61101, but today we are only going to discuss the related party transactions. The focus of related party transaction requirements in MI 61101 is on transactions with the potential for significant expropriation of value from minority security holders. When an issuer enters into a transaction with a related party, it's important to determine if the transaction falls within the scope of MI 61101 because MI 61101 has its own definition of related party and related party transactions. In circumstances where conflicts of interest may arise, including related party transactions, issuers may be required to provide additional disclosure, obtain a formal independent valuation report, obtain minority security holders' approval, and have an independent committee of the board consider the transaction. There are exemptions within MI 61101 for formal valuations and minority shareholder approval. However, if an exemption applies, it must also be disclosed. Examples of a related party transaction that may be within the scope of MI 61101 include a sale or purchase of assets to or from a related party, issuing securities to a related party or subscribing for securities from a related party, borrowing or lending money with a related party, and forgiving debts and liabilities of a related party. It is especially important for issuers to consider MI 61101 prior to finalizing a related party transaction in order to ensure that the additional disclosures or valuation reports and shareholder approvals that could be required are obtained in a timely manner. Failure to do so may result in delays in finalizing the transaction. If a transaction is subject to the requirements of 61101 and a material change report and/or information circular is required to be filed, we find certain mandatory disclosures are often missing. Section 5.2 requires that the disclosure contained in a detailed description of the interest in the transaction of every interested party and the related parties and associated entities of interested parties. It also requires disclosure of the anticipated effect of the transaction on the percentage of securities of the issuer or of an affiliated entity of the issuer, beneficially owned or controlled by each party, for which there would be a material change in that percentage. So if the transaction will materially change the ownership of a related party, that change in percentage must be provided. We often find these disclosures are missing from material change reports used to report the transaction. Section 5.3 of MI 61101 requires a description of the background to the transaction, and we often find that this is missing from information circulars filed. There is a requirement to provide a discussion in both the material change report and any information circular of the review and approval process adopted by the board and special committee if one exists for the transaction, as well as a discussion of any contrary views or abstentions by directors or material disagreements between the board and special committee. We often find that this disclosure is inadequate or missing completely. In order to ensure that the requirements of MI 61101, when applicable, are met, reporting issuers will want to develop processes regarding related party transactions that ensure financial statements and MD&A disclosures are complete, and identify transactions that specifically fall within the scope of MI 61101. A checklist or process to document the required disclosures of MI 61101 is also helpful. For example, a checklist may help to ensure that the material change report includes a description of the transaction and its material terms, explains the purpose and business rationale for the transaction, as well as the expected impact on the business and operations. It's also beneficial to have documented evidence of the review and approval process, as well as any differing views that would be required to be disclosed. It's important to understand all of the parties involved and their interests in the company, including the impact the transaction has on their ownership. If a valuation report is necessary, it is helpful for the checklist to include documentation of the valuation techniques, including the assumptions that were used in the calculation of fair value that could be used in creating the required disclosures. Lastly, if any exemptions in MI 61-101 are relied upon, it's important for those to be disclosed. Related party transactions are an important part of many issuers' businesses. Therefore, it is critical that the required disclosures are robust and complete for readers to understand the full effect on the company. That concludes my discussion on related party disclosures. Before we continue on to the next subject in our presentation, here is the first CPD learning code. The first code word is securities. As Jennifer mentioned, you will need to enter this word in the survey at the end of the presentation to get your CPD credit. Now I'll pass it over to Vernon to discuss management cease trade orders.
Okay, thank you, Chelsea. My name is Vernon Cooney, and I'm here to discuss National Policy 12203, Management Cease Trade Orders, known as the MCTO. An MCTO application may be made by an issuer for a specified default to avoid a failure to file a cease trade order, an FFCTO. A specified default is for an annual or an interim financial statement filing. The MCTO generally restricts the trading in the issuer's securities by the CEO and the CFO. The public can continue to trade in the securities of the issuer after the MCTO is granted. The issuer seeking an MCTO will need to file an MCTO application on SEDAR+. This must be done 2 weeks before the specified default is to occur, and the issuer must meet the eligibility criteria. We may accept a late application with an explanation, but not after the filing deadline. The eligibility criteria. We will consider granting an MCTO if the issuer satisfies the following criteria. The outstanding filings are expected to be filed as soon as they are available and within 2 months. The issuer is generating revenue from its principal business, or if it's a development stage company, actively pursuing the development of its products or properties. The issuer has the necessary financial and human resources, including reasonable number of directors and officers in place to remedy the default in a timely and effective manner and comply with other continuous disclosure requirements. The issuer's securities are listed on a Canadian stock exchange, and there's an active liquid market for those securities. And the issuer is not defaulting reporting issuer on with a CSA jurisdiction for any reason other than for the specified requirement. The issuer should explain if they do not meet the eligibility requirements for our further consideration, or reach out to us to discuss before filing the application. If exceptional circumstances do exist, this should be explained in the application. The application contents. In the application filed on SEDAR+, as per Item 8 of National Policy 12203, you should include the following. Identify a specified default, the reasons for the default, and the anticipated duration of the default. Explain how the issuer satisfies each of the eligibility criteria. Set out a detailed remediation plan and timetable that explains how the issuer proposes to remedy the default. Include the signed consents of the CEO and the CFO. Include a default announcement. The issuer may provide a draft announcement with their application, which staff may assist the issuer with filing prior to the MCTO being issued. Confirm that the issuer will comply with the alternative information guidelines known as the biweekly default status reports. Include a copy of the undertaking. The issuer undertakes to not distribute securities while subject to the MCTO with limited exceptions. And briefly describe the issuer's blackout policies and other policies related to insider trading. On a biweekly basis, the issuer is to file on SEDAR+ a default status report containing any changes in the information contained in the default announcement or subsequent default status reports that would reasonably be expected to be material to an investor. Particulars of any failure by the default reporting issuer in satisfying the provisions of the alternative information guidelines. Information regarding any anticipated specified default subsequent to the default, and any other material information concerning the affairs of the issuer. Other considerations. Common application deficiencies for an MCTO application being filed are incomplete application with errors or missing documents, lack of details explaining the reasons for the default, an unrealistic anticipated filing date, not enough information in the remediation plan, and an explanation of the status of the audit, what is to be completed and by when. If the issuer is subject to insolvency proceedings, this alone does not exclude the issuer from applying for an MCTO. An MCTO application is made for only one filing period specified requirements. If the MCTO is in place for annual filings and the interim filings default before the annual filings are filed, the interim filings may be added to the MCTO at that time. An MCTO application currently requires an application of $750 as per ASC Rule 13501. Thank you, and I will now turn it over to Nicole to discuss semi-annual reporting.
Thank you, Vernon. As mentioned, I'm here today to talk about the CSA's proposed multi-year pilot to allow eligible venture issuers to voluntarily adopt semi-annual financial reporting, which was announced on October 23rd, 2025. As proposed, the semi-annual reporting pilot would provide an exemption for certain issuers listed on the Canadian Venture Exchange from the requirement to file the first and third quarter financial reports under National Instrument 51102. The pilot would be introduced through coordinated blanket orders across the CSA. The objective of this discussion is to provide you with an understanding of what has been proposed and how it will reduce regulatory burden for an eligible issuer. To accomplish this, we will be covering what is semi-annual reporting, who would be eligible, how an eligible issuer would be able to opt into the SAR pilot, and when the SAR pilot would be effective. A reporting issuer in Canada must comply with the filing requirements and deadlines outlined in National Instrument 51102. For venture issuers, this includes filing an interim report within 60 days after the end of the interim period, along with the related MD&A for the 3, 6, and 9-month interim periods, together with certification of the foregoing filings as required in National Instrument 52109. While quarterly reporting may provide timely information to investors and intermediaries, some stakeholders are of the view that there may be instances in which the cost of preparing such frequent reporting for smaller venture issuers exceeds the benefit to investors and the market. The proposed coordinated blanket order 51933 exemptions to permit semi-annual reporting for certain venture issuers, if adopted, would provide an exemption from the requirement in National Instrument 51102 to file an interim financial report for each of the 3 and 9-month interim periods, subject to certain terms and conditions that we will discuss later in the presentation. The issuer relying on the blanket order would not be required to file an interim financial report, related MD&A, or the interim CEO and CFO certificates for the 3 and 9-month interim periods. To opt into the semi-annual reporting pilot, an issuer would be required to issue and file a news release specifying that the issuer intends to rely on blanket order 51933 and does not intend to continue to file interim financial reports and related MD&A for the 3 and 9-month interim periods. The news release is required to provide transparency and set expectations for the timing of future interim financial reporting. While relying on the blanket order, an issuer would still have to comply with the filing deadlines in National Instrument 51102 when filing an interim financial report and related MD&A for the 6-month interim period, and the certification of those filings as required in National Instrument 52109. For example, assuming the blanket order was effective, a reporting issuer with a December 31st year end, adopting semi-annual reporting beginning with the 3 months ended March 31st, 2026, would be required to file a news release between April 1st, 2026 and May 30th, 2026, specifying that the issuer is adopting semi-annual reporting and does not intend to continue to file an interim financial report and related MD&A for the 3 and 9 month interim periods, and will commence relying on the blanket order beginning with the 3 months ended March 31st, 2026. The issuer's obligations for the 6 month interim period would remain unchanged. So it would then file the interim financial report and related MD&A for the 6 months ended June 30th, 2026, along with the certification of the foregoing filings before the August 29th filing deadline. No filings would be required for the 9 months ended September 30th, 2026. Lastly, the annual filing requirement would remain unchanged, and the issuer would still file audited annual financial statements for the year ended December 31st, 2026, on or before April 30th, 2027, 120 days after year end. The semi-annual reporting pilot would be voluntary. An eligible issuer must opt into using it. To be eligible to rely on the exemptions in the blanket order, the issuer must meet the terms and conditions of the blanket order and must, among other things, have securities listed on the TSXV or the CSE, annual revenue of no more than $10 million, at least a 12-month continuous disclosure record, and filed all periodic and timely continuous disclosure documents required to be filed. Now, there are a few conditions and restrictions that eligible issuers must follow while relying on the blanket order and not filing their first and third quarter financial reports. The exemptions in the blanket order do not apply when an issuer stopped relying on the blanket order in the last 12 months. This condition is intended to prohibit issuers from opting in and out of the semi-annual reporting pilot, as this could cause confusion in the market, especially for investors. And if an issuer frequently changes the cadence of when it reports interim financial reports. If there is a change in an issuer's financial year end, as this may result in significant periods with no financial disclosure. We understand that in connection with certain restructuring transactions, an issuer may intend to change its financial year end. In this situation, we would encourage the issuer to contact their principal regulator to discuss staff's expectations for financial disclosure post-transaction. The pilot is intended to reduce burden in respect of continuous disclosure requirements. It is not meant to alter prospectus or prospectus level disclosure required in the context of a prospectus offering or a circular. As such, issuers relying on the blanket order would not be allowed to file a short form prospectus or undergo a significant transaction requiring the filing of an information circular, a takeover bid circular, or an issuer bid circular containing prospectus level disclosure about the issuer. Issuers planning to file a short form prospectus or circular while relying on the blanket order are also encouraged to contact their principal regulator to discuss staff's expectations for the financial disclosure. Further, as the semi-annual reporting pilot is not meant to alter prospectus level disclosure, the pilot is not compatible with continuous distributions under shelf prospectuses. This includes the filing of a base shelf prospectus as well as a shelf prospectus supplements under a base shelf prospectus that was filed prior to opting into the semi-annual reporting pilot. As previously mentioned, an issuer relying on the blanket order and opting into the semi-annual reporting pilot would be required to issue and file a news release. The news release is intended to provide transparency to the market about the issuer's future filings and allows investors and intermediaries to file their expectations to the timing of future interim financial reporting. So it is important that issuers consider filing the news release as soon as possible, after the end of the initial interim period, for which they do not intend to file an interim financial report and related MD&A. In circumstances where an issuer determines it can no longer rely on the blanket order or chooses to opt out of the semi-annual reporting pilot, the issuer is required to file a news release informing investors that it will opt out of the pilot and indicate the timing for the next expected interim period for which interim financial reports and related MD&As will be filed. Once an issuer opts out of the pilot, it will be required to comply with all quarterly financial reporting requirements, including comparative financial information. The CSA published the notice of publication and request for comment on proposed coordinated blanket order 51933 exceptions to permit semi-annual reporting for certain venture issuers on October 23rd, 2025. The public comment period expired on December 22nd, 2025. We thank everyone who submitted feedback. The CSA is currently reviewing and considering the feedback received. We hope to implement the pilot under the blanket order quickly. Please stay tuned for further updates. In addition, the CSA intends to initiate a broader rule-making project related to semi-annual reporting, using the pilot project to inform the initiative. In the interim, use and compliance with the pilot would be monitored, as well as international developments related to semi-annual reporting. I will now pass it over to Oliver.
Thanks, Nicole. The Listed Issuer Financing Exemption, or LIFE, is a new prospectus exemption set out in National Instrument 45106, Prospectus Exemptions. It provides a more efficient method of capital raising for reporting issuers that have filed all timely and periodic disclosure documents required under securities legislation. It was adopted by all CSA members and came into effect on November 21, 2022. The exemption relies on the issuer's continuous disclosure record as supplemented with a short offering document and allows issuers to distribute freely tradable listed equity securities to the public. On May 15, 2025, substantively harmonized relief from certain conditions of the LIFE exemption came into effect, which significantly increased the amount that can be raised under the exemption. I'll cover the relief implemented through the blanket order in greater detail later in the presentation. What are the key conditions of LIFE? An issuer must meet several key conditions to qualify to be able to use the listed issuer financing exemption. These conditions apply both to the original LIFE exemption as well as the expanded relief provided by the blanket order. An issuer must issue a news release announcing the offering, have been a reporting issuer in Canada for at least 12 months prior to the news release announcing the offering, have a class of equity securities listed for trading on a Canadian stock exchange, have filed all periodic and timely disclosure documents, have an active business operations, and its principal asset is not cash, cash equivalents, or its exchange listing be a capital pool company. Reasonably expects to have available funds to meet all business objectives and liquidity requirements for 12 months after the offering, and finally, an issuer that is not an investment fund. The listed issuer financing exemption is only available for the distribution of listed equity securities and units consisting of listed equity securities and warrants convertible into listed equity securities. The proceeds cannot be used to fund a significant acquisition, a restructuring transaction, or any other transaction that requires security holder approval. The offering document must comply with Form 45106 F19. It's not subjected to prior staff review. However, once filed, it may be reviewed by ASC staff to ensure the issuer is in compliance with the requirements of the exemption. If material deficiencies are identified, the issuer will generally need to amend and refile the offering document and file any required unfiled documents. For this presentation, we've highlighted three key areas that warrant further discussion: the blanket order, sufficiency of funds, and the dating of the certificate. The blanket order. Coordinated Blanket Order 45-935 provides optional relief to issuers to certain conditions of the LIFE exemption. Following introduction of the LIFE exemption, market participants provided positive feedback on the exemption, but noted that the capital raising limits were restricting the use of the exemption. Since May 2025, increasing the capital raising limits has allowed listed reporting issuers to raise significantly more capital. In addition, the blanket order introduced changes related to the timing of the 50% dilution limit, addressing a condition of the exemption that requires the calculation to be based on the issuer's outstanding securities 12 months before the offering. Under the LIFE exemption, listed reporting issuers are limited to raising the greater of $5 million and 10% of the issuer's aggregate market value to a maximum of $10 million in a 12-month period, subject to the 50% dilution limit. The blanket order provides relief from these conditions by allowing listed reporting issuers to raise the greater of $25 million and 20% of the aggregate market value of the issuer's listed securities to a maximum of $50 million in a 12-month period, subject to different provisions related to the 50% dilution limit. The blanket order provides that for the purposes of the 50% dilution limit, the timing for calculating the outstanding securities is the date of the news release announcing the offering if an issuer has not relied on the exemption or blanket order in the last 12 months, or the date of the news release announcing the first offering completed in reliance on the exemption or the blanket order in the last 12 months. Further, under the blanket order, only warrants convertible into equity securities of the listed issuer within 60 days of closing the distribution need to be factored into dilution calculations. If the issuer does not elect to use the blanket order, common shares that are issuable on exercise of warrants must be included when calculating the 50% dilution limit. It's important to note that under the blanket order, the distribution cannot result in a new control person or result in a person or company acquiring ownership or exercising control or direction over securities that would result in the person or company being entitled to elect a majority of directors. A reporting issuer relying on the expanded relief in the coordinated blanket order must state on the cover page of the offering document that is relying on the exemption in the blanket order and is qualified to distribute securities in reliance on the exemptions included in the order. CFSA Staff Notice 45-330 is a Q&A of frequently asked questions regarding the use of the life exemption and should be consulted prior to drafting a life offering document. This notice was revised following publication of the coordinated blanket order, and comment 12 in that notice explains how the exemption and blanket order interact. Sufficiency of funds. One of the requirements under the life exemption is that the issuer has sufficient available funds to meet the issuer's business objectives and liquidity requirements for a period of 12 months after the offering closes. The issuer must ensure the minimum offering amount is such that, following completion of the distribution, the issuer will meet this requirement. Items 8 and 9 of Form 45-106-F19 sets out the required contents of the offering document and requires the issuer to specify what the total available funds upon closing of the offering will be and how they will be used. In situations where there is a significant decline in working capital since the most recently completed audited financial statements, that decline is required to be explained. Further, if the issuer's recently filed financial statements include a going concern note, that fact must be disclosed, along with an explanation as to how this offering impacts the issuer's going concern. Staff may also review the issuer's continuous disclosure documents to assess whether the issuer satisfies the sufficiency of funds requirement and will consider whether the disclosure in the offering document provides potential investors with sufficient information regarding the sufficiency of funds. The available funds requirement is discussed in further detail under Comment 3 in CSA Staff Notice 45-330 and provides additional guidance as to what funds can be included in the calculations under items 8 and 9. While issuers may include additional sources of funding in their calculation, these funds must be fully committed at the time of closing of the offering to be considered. Certification. The listed issuer financing document is considered a core document under applicable Canadian securities law, and as such, the issuer will be liable to purchasers under the statutory secondary market liability provisions if there is a misrepresentation in the certified documents. The CEO and CFO of the issuer are required to certify that the listed issuer financing document, together with certain filed documents, disclose all material facts relating to the securities being distributed and do not contain a misrepresentation. We've noticed numerous offering documents having been filed with an incorrect date in the certification, requiring a refiling of the document. The most common error is that the date included in the certification paragraph in item 15 of the form is the same date of the offering document itself within item 16. These dates should never be the same. The template guidance for the form requires the issuer to insert in the certification paragraph the date which is the earliest of the date that is 12 months before the date of the offering document and the date that the issuer's most recent audited financial statements were filed. Filing deficiencies. Certain other filing deficiencies are also quite common, and as a reminder, 3 primary documents to be filed under life include a news release announcing the offering and location of the offering document, a completed Form 45-106F19 listed issuer financing document, and Form 45-106F1 report of exempt distribution. Each of these documents are required to be filed in the jurisdictions where the offering takes place. It's also important to note that the completed form of offering document must be filed on SEDAR+ no later than 3 business days after the date of the form, and the report of exempt distribution is to be filed 10 days after the closing of the offering. In addition to comments we may raise regarding sufficiency of funds, other common issues we see related to filings are that the issuer's corporate governance and executive compensation disclosure is not up to date, the certification of the completed offering document, as I discussed earlier, is often dated incorrectly, and the completed form is required to be made available on the issuer's website. Oftentimes, this is not done. As noted at the outset of this presentation, one of the requirements to use the life exemption is that reporting issuers have filed all periodic and timely disclosure documents, and issuers looking to use the exemption to take care to ensure that all required documents have been filed and dated correctly. This concludes the life portion of this presentation. Before we start our next session, here's the second CPD learning code for you. The code word is life. We'll leave this code up for a moment, and I'll pass it over to Anthony, who will provide a regulatory update.
All right, thanks, Oliver. Good morning, everyone. My name is Anthony Potter, and I'm the Manager, Corporate Disclosure and Financial Analysis in the Corporate Finance Division. In addition to proposed changes regarding semi-annual reporting and the changes made regarding use of the life exemption, there have been a number of other regulatory changes, and here's a summary of the topics to be covered in this segment. The first topic I would like to cover is the WKSI regime. On August 28, 2025, the CSA published final amendments to National Instrument 44-102, Shelf Distributions, that introduce an expedited shelf prospectus regime for WKSIs in Canada. The amendments expand on and replace the regime that had been implemented in January 2022 by blanket order. They create a permanent WKSI regime that permits reporting issuers that satisfy the qualification criteria and certain conditions to file a final base shelf prospectus and be deemed to receive a receipt for that prospectus without first filing a preliminary base shelf prospectus or undergoing any regulatory review, to omit certain disclosure from the base shelf prospectus, and benefit from receipt effectiveness for a period of 37 months from the date of its deemed issuance, subject to an annual requirement for the issuer to reassess its qualification to use the WKSI regime. The amendments retain some of the conditions from the blanket order, including the 12-month seasoning period, as well as the listed equity securities requirement of at least $500 million, or qualifying public debt, distributed under a prospectus in primary offerings for cash within the preceding 3 years of at least $1 billion. For mining issuers, it also retains the gross revenue requirements of $55 million for the most recently completed financial year, and $165 million for the 3 most recently completed financial years. Eligibility for certain types of issuers was expanded from the blanket order, and the amendments set out circumstances where an issuer would be ineligible to use the regime. For example, due to a proceeding regarding a prospectus or distribution, being convicted of an offense or the subject of an order, decision, or settlement agreement, where sanctions, conditions, or restrictions are imposed as a result of a contravention of laws in Canada or the United States regarding securities or derivatives, or being subject to a CTO or cease trade order in effect for more than 30 consecutive days. Under the new regime, PIFs are only required if requested. For those issuers using or looking to use the permanent WKSI regime, you are strongly encouraged to review Part 9B of the Companion Policy to National Instrument 44-102. In particular, issuers need to be aware that all requests for relief must be filed and the exemptive relief must be granted in advance of filing the WKSI base shelf prospectus. Any exchange of new debt for old debt doesn't meet the offered for cash requirement and is excluded from the calculation of qualifying public debt. For MJDS issuers are encouraged to contact staff in advance and use the confidential prospectus pre-filing process to avoid timing problems where staff may raise comments as part of their process to be prepared to issue a notification of clearance. Moving on to non-GAAP measures. In April 2024, the International Accounting Standards Board issued IFRS 18, Presentation and Disclosure in Financial Statements, which is effective for annual reporting periods beginning on or after January 1, 2027. Among other things, IFRS 18 requires disclosure of management-defined performance measures, or MPMs, in a note to the financial statements. The CSA has proposed amendments to National Instrument 52-112 to ensure such measures that have historically been considered non-GAAP financial measures remain subject to its requirements. The disclosure requirements for MPMs in IFRS 18 are not consistent with the disclosure requirements for non-GAAP financial measures in National Instrument 52-112. On November 13th, the CSA published for comment proposed amendments to National Instrument 52-112. To reduce duplicative disclosures, the CSA has proposed to allow incorporation of information by reference to the notes to the financial statements, if such notes contain the information required by National Instrument 52-112. The public comment period closes on February 11th, 2026. Turning now to two remaining reducing regulatory burden initiatives. I'll start with access equals delivery for CD documents. Under an electronic access model, it was proposed that providing access to documents and alerting investors that they were available would have constituted delivery of the documents. The substance and purpose of the proposed amendments was to modernize the way information is communicated to investors and recognize that investors are increasingly consuming information electronically. With respect to prospectus documents, the proposed access model was generally well received, and new rules came into effect in April 2024. Comments, however, suggested more work was required to develop a successful access model for continuous disclosure documents. In November 2024, the CSA republished for comment proposed amendments. The proposal would allow investors to sign up and receive an email notification through SEDAR+ of the filing of documents, but allow investors to continue to request or provide standing instructions to receive the documents in paper or electronic form. 15 comment letters were received, and the CSA is currently working on a response. Next is the streamlining of annual and interim continuous disclosure obligations. The CSA was close to finalizing the streamlined consolidated annual and interim disclosure statements, but paused the project to avoid introducing the changes before the access model for continuous disclosure documents was available. With the amendments to introduce an access model for CD documents now advancing, the CSA has resumed work to finalize amendments that would introduce consolidated annual and interim disclosure statements. We anticipate publishing those final amendments in 2026, but will ensure reporting issuers are provided with sufficient lead time to transition to the new forms and requirements. Moving on to other initiatives. In an effort to ensure a competitive Canadian capital market, in April 2025, the CSA introduced a number of exemptions from securities laws via 3 harmonized blanket orders. Coordinated Blanket Order 41930, Exemptions from Certain Prospectus and Disclosure Requirements, provides relief from certain requirements associated with filing a prospectus. First, it provides an exemption from having to provide third-year financial statements, meaning that only 2 years' financial statements or operating statements are required. Second, it provides an exemption with respect to marketing materials in relation to disclosing specified pricing information, which can instead be provided through a news release. And it provides an exemption from the requirement to provide a promoter certificate, such that a promoter certificate would not be required if the promoter is signing the prospectus in another capacity, or the reporting issuer has been a reporting issuer for at least 2 years, and the promoter is not a control person or a director or officer. This aspect isn't much different from prior ASC practice, but does reflect a change in certain jurisdictions, creating a harmonized CSA position. Coordinated Blanket Order 45930, Prospectus Exemption for New Reporting Issuers, provides a prospectus exemption for companies that will be going or have recently gone public in Canada through an underwritten IPO. It can serve as a financing tool for issuers that don't yet meet the 12-month seasoning requirement associated with WKSI or Life. Certain conditions must be met, including the exemption is only available for 12 months following the receipt of the final long-form prospectus. The maximum amount that can be raised under the exemption is $100 million. The security being distributed must be the same class of security as distributed under the IPO, and the offering price cannot be less than the price under the IPO prospectus. An offering document, similar to the one required under the Life exemption, must be filed, and proceeds cannot be used for a restructuring transaction or a transaction requiring shareholder approval. Finally, under Coordinated Blanket Order 45933, the investment limit in the offering memorandum exemption increases for certain investors to allow for reinvestment of proceeds within a 12-month period. These amounts vary depending on the type of investor, as shown here. National Instrument 45106, Prospectus Exemptions, defines who is an eligible investor and includes individuals who meet specific net asset or net income tests. Certain general or limited partnerships, certain trusts or estates, an accredited investor, and persons who meet the family, friends, and associates eligibility criteria. As explained in the companion policy to National Instrument 45106, the fact that investment limits have been established for eligible and non-eligible investors who are individuals does not mean that these amounts are suitable investments in all cases. If a registrant is involved in a transaction, registrants remain subject to their suitability assessment obligations. Turning to climate-related and diversity disclosure, in April, the CSA announced that it was pausing its work on the development of a new mandatory climate-related disclosure rule. This pause was done to support Canadian markets and issuers as they adapt to recent developments in the US and globally. While paused, the CSA plans to continue to monitor disclosure practices in this area and will provide information and additional guidance as appropriate. In conjunction with the announcement in relation to climate-related disclosure and for similar reasons, the CSA has also paused proposed amendments with respect to diversity-related disclosure. While paused, non-venture issuers will continue to be required to provide disclosure in relation to women on the board and in executive positions, based on the existing requirements under National Instrument 58101, Disclosure of Corporate Governance Practices. For both of these areas, domestic and international regulatory developments will continue to be monitored, and the CSA expects to revisit both projects in future years. Just a few final comments with respect to investment funds. In March 2025, new rules became effective that allow an investment fund in continuous distribution to file a new prospectus every 2 years. There are also proposed amendments to replace the existing annual and interim management report of fund performance with a new annual and interim fund report intended to be more user-friendly for investors, and also eliminate some class or series level disclosure from investment fund financial statements that are not required by IFRS. The comment period ended on January 17th, 2025, and the project is now being pursued in different work streams. While certain amendments are anticipated to be able to be finalized in 2026, the development of a replacement for the management report of fund performance document is expected to take somewhat longer to allow for further investor testing. Last, the CSA is moving forward on an access model for delivering financial statements and the report of fund performance or fund report. We anticipate that we will publish a proposal for comment in 2026. That concludes the regulatory update. Now I'll hand it over to Tanya to discuss the proposed new self-certified investor prospectus exemption.
Thank you, Anthony. All right. So we're going to talk now about multilateral instrument 45111, and that is the self-certified investor prospectus exemption. Now, this is an exemption that is likely of greatest interest to the kind of smaller issuers who are looking to raise capital from a pool of people that are beyond just accredited investors. So a bit of an introduction here. I'm just going to advance my slide here, maybe. There we go. Okay. So first of all, this is me. I lead our private market and innovation team here at the Alberta Securities Commission, and we regulate activity in the private markets. And we particularly do a lot of work in terms of engagement with founders and startup businesses who are looking at raising capital and interested in understanding the rules to do so. So as a bit of a fundamental for a business that's looking to raise capital, you of course start with the whole idea that you have to have a prospectus. However, there is an option to utilize a prospectus exemption. So the starting point is always a prospectus is required, and then there's an option to utilize what we call a prospectus exemption. We use these exemptions in a situation where the preparation of a prospectus is quite expensive relative to the amount of capital that the business is looking to raise. And you'll hear them called prospectus exempt offerings or private placements, things like that. But it's basically when a business is raising capital and they're using an alternative route than a prospectus. And most of our prospectus exemptions are harmonized, and they're in 45106. But we do have some exemptions that sit outside of 45106. So this would be an example. A multilateral instrument is one that will cover multiple provinces and territories, but not all of them. So in this case, in this particular multilateral instrument, we have almost harmonization across the country, but at this time, we don't have the participation of BC or Quebec. So this multilateral instrument went out for comment, and the comment period just closed in early January. We have a number of comments and really quite significant support for this exemption, with some suggestions, which of course is what we expect in a comment period. So we'll come back as a group and we'll review all those comments, and this will advance. Now, just to give you a bit of background on kind of the why, like why do we need to, or why would we want, what's the policy reason for having a prospectus exemption such as this one, the self-certified investor? This is a real life example, and Emily is a woman in the US. She is someone who is well educated. She has fairly significant net worth, but she doesn't meet the criteria for being an accredited investor. And in this case, Emily is located, she's in the US, and she is actually suing the SEC saying, wait a second, I have financial acumen, I have fairly strong net worth, but I don't meet the criteria to be an accredited investor. I want to participate in this private market. Okay, so back to our self-certified prospectus exemption. So again, as I said, we're largely harmonized across the country. And we have all the jurisdictions currently participating in this initiative other than BC and Quebec. Now, with this particular exemption, there is a limit on the amount of money an individual investor can invest, and that limit is $50,000 a year. That's one of the areas that we received a lot of comment on, not surprisingly. So, some people thought that was maybe too high. Some people thought it the limit should be eliminated entirely. So that will be one of the discussion points that we'll talk about as we come back together as a group. But in this particular exemption, we do have a financial limit for this particular type of investor, with one exception, and that exception relates to a special purpose vehicle. So sometimes in a deal, you'll see that the minimum investment amount will be $25,000. If you see a deal and the minimum is 25 million, you think, okay, this is probably not going to work for you. But if it's $25,000 as a minimum investment, what will sometimes happen is people will form what's called a special purpose vehicle. They'll form an entity, and then multiple investors will come in as shareholders of that particular entity, and the entity will turn around and invest in the business that is raising the capital. And in that case, a special purpose vehicle doesn't have a limit in terms of their ability to invest. There's no specific offering document that must be provided to an investor, but the investor does have some paperwork to complete. They must confirm that they qualify to invest, and they also must acknowledge the risks of an investment. And this, of course, it makes sense. So this is primarily a private market tool. So there's a number of ways that someone can qualify as a self-certified investor. They can do so via their employment, their degree, their designation, and an examination. And a lot of time you'll have people who will qualify in multiple areas, but they really just need to meet one qualifying criteria. So in terms of employment experience, there'll be criteria, and it will say this is the type of employment experience you must have, and the amount of time you must have been in that type of role. So qualifying employment will be one of the criteria. Qualifying degree is another one. So again, these are degrees which would be relevant to understanding the risks of investing in a company like that. So you'll see that there's often a time period as well. So not just a degree, but they also have to have some time some time working, not just an instant grad. And then there's also the designation. So this is the whole, do you have some letters behind your name? If you do, a lot of those letters will be relevant here. So you'll look through the list, and if you meet one of those, box checked, and you will meet a qualifying criteria. Or lastly, there's the ability also to qualify by having passed certain examinations. Okay, so we're going to do some audience participation. We'll see if this works. So look for you to join Slido. And our first quiz is a woman named Natalie. So Natalie has a Doctor of Dental Surgery degree from the U of T. Now she's lived and worked in Manitoba. She's worked as a dentist since 2020. And she's looking to invest $45,000 into a dental clinic that's located in Saskatchewan. So if you'll scan the QR code, and let's just see if she will qualify as an accredited investor. See what you think. Okay, so I've actually brought the answer up on the screen here. So anyone that hasn't answered yet, you get to have the advantage of seeing. So in this case, Natalie, she will qualify. So she does have qualifying employment, and she's worked as a dentist since 2020. So she has a number of years of experience. So she has the ability to have direct experience with the type of business she's investing in. And so Natalie would qualify as a self-certified investor. We have another individual now. So now we have Anna, and Anna is in the process of doing her law degree at the U of C. So, and she's done that directly out of a BCom, and she's worked at a number of startups as her summer job. So this summer, she had the great fortune of working at Platform Calgary, which is like a very fun place to work, I'm quite sure. And she worked with a legal tech company that's using AI to help lawyers. and she's looking to invest about $10,000 in the startup. Now, does Anna qualify as a self-certified investor? So for Anna, unfortunately, she doesn't qualify. So she hasn't yet finished her law degree. And even though she has a BCom, she went directly from her BCom into law school, and she doesn't have the requisite amount of work experience. So unfortunately, Anna is not going to qualify as a self-certified investor. And we've got Krista now. Krista has her Bachelor of Administration from the U of A, and she's worked for about 2.5 years at an accounting firm, and she just received her CPA designation. She's a Medicine Hat. She was at a startup event, and she's really interested in investing in one of the companies that she saw through that event. She wants to invest $50,000. So would Anna qualify as a self-certified investor? So in this case, because Anna has her CPA, she can use her qualifying designation. So there may be other ways that she could qualify, but once you meet one particular qualifying criteria, you're in. She has a CPA, and she can invest, and she can invest that $50,000 amount. And we have one final example. So this is George. He is a doctor. He's graduated from Dalhousie in 2019. And just a little additional fact, he's just paid off his student debt. Hooray. So he's ready now. He's got some extra money, and he wants to invest. So he has his best friend's cousin is innovating in the dairy industry. He's starting a dairy farm operation in Ontario, and George really knows that healthy organic food, milk products can really make a difference in terms of health. He's looking to invest. Now, how about George? Obviously, well-educated guy. He's got good income potential, although he's just starting off. Just paid off his student debt. Does George qualify to invest as a self-certified investor? And this is a situation where someone can be very educated and experienced, but still not actually meet the relevant qualifications for this exemption. Now, George may, in a few years, perhaps be able to qualify as an accredited investor by meeting certain income thresholds, but he wouldn't qualify as a self-certified investor. With this exemption, as with so many of our other exemptions, the obligation for compliance is on the issuer or the company that's selling the securities to make sure the person is eligible to invest. So there's a self-certification procedure where the person is filling out the particular paperwork, certifying that they do meet the qualifying criteria, but it's the responsibility of the issuer to make sure that that is in fact there is, something that's checked off that is one of the qualifying criteria in order to accept the money from that particular investor. So you can always consult the companion policy to this particular exemption. You can call us at the ASC, and we'd be happy to answer your questions. Or if you have a securities lawyer that you regularly work with, this will be something that they will also be able to help you with. Thank you for bearing with us as we had some technical issues on this particular presentation. Again, feel free to call or email, and I'd be happy to help you if you have questions on this self-certified exemptions or other exemptions. We have a learning code for you if you're still with us, and that code is INVESTOR. And at this point, I'm going to turn it over to Denise Weirs, and we'll go from there. Thanks.
Okay, thanks, Tanya. All right, we will move into the Q&A session. Tanya, two clarification questions for you. One is this multilateral instrument's not yet effective. Do you have a sense of timing for that?
Yeah, that's correct. So we've just come out of the comment period. We'll now regroup with all the jurisdictions that are working on this to go through, consider those comments. So we would anticipate that this instrument as described, you'll see it later this year, 2026 or early 2027.
Okay, and you mentioned that it was sort of a private market initiative, but this audience is largely going to be reporting issuers. Is it contemplated that it's available for reporting issuers?
Yeah, it is as well. It is absolutely, although we do think it will primarily be of interest to some of our businesses in that startup and small business space.
Okay, great, thank you. All right, we've got a few questions here, some focusing on the listed issuer financing exemption. The first one is, can an issuer that's relying on the semi-annual reporting blanket order pilot, once that becomes effective, could they still use the listed issuer financing exemption? Nicole or Oliver, are you able to speak to that one?
Yeah, I can do that one. So yes, the issuer would still be able to use the life offering exemption while under the SAR pilot.
Okay, great, thanks. Also, don't go away, Nicole, on another question on the semi-annual reporting. So what if a company starts to they use the pilot, they're relying on the blanket order, and then down the road in a year or something, they either they want to file a prospectus or, an information circular that's required to have prospectus level disclosure. How would they proceed then? What's required in that circumstance?
So in that situation, the issuer would be required to file everything that would be required for the prospectus level requirements. That would also include comparative financial information. I will note though, if you file a base shelf prospectus, that you do have to stop relying on the SAR pilot project. We would encourage any issuer, if they run into the situation, to reach out to their PR with any specific questions.
Okay, so they would file those, they would have to file the quarterly with the prospectus or the information circular.
Correct, yeah. And the quarterly would have to include the comparative period.
Right, okay. Another question here. Okay, I think I think you've answered it. It's saying, again, on semi-annual reporting, do the exemptions not apply if the issuer files an information circular? Oh no, you didn't answer it, because this is just a regular information circular for its AGM. So I think making a distinction between a regular information circular that wouldn't be required to have prospectus disclosure versus one that's dealing with a restructuring transaction or something.
Yeah, so if it's just your regular information circular for AGM, then that would be completely fine under SAR.
Okay, they'd be able to continue to rely on it. All right, great. Another question here, back to you, Tanya. This is the self-certified exemption. The question is whether there's any relief for first trades. So sort of resale relief so that investors could sell to each other later on. So I guess I don't know if it's just selling within the pool of self-certified investors, yeah, or selling to others. So I think, oh, Tanya. Okay, we'll come back to that. Okay, if Tanya's frozen.
I'm back. Can you
hear
me?
Okay, yeah, we can hear you. Yeah.
Okay, so sorry, thanks for that question. So yes, there is contemplation that, like the accredited investor exemption, the self-certified investors would be able to sell to other self-certified investors or to accredited investors, they would need to utilize an exemption, and that will be possible here.
Okay, great, thanks. And is there any difference in the reporting, the reports of exempt distribution for self-certified investors, or the timing of reports compared to any other exemptions?
So for the reports of exempt distribution, there is a longer period that's contemplated. So allowing people 30 days to file the report of exempt distribution rather than the typical 10 days.
Okay, thanks, Tanya. This one I think is maybe for Jennifer. It says because it says in the presentation about current global events and uncertainty, you spoke mostly about requirements in the MD&A and the financial statements, but those are only required to be updated on a quarterly basis. So what's sort of the expectation for more timely disclosure, news releases or whatever about those types of matters? Jennifer, we can't hear you right now. I don't know if you're on mute.
Yeah, I'm back. Sorry about that. That's a great question. More timely disclosure is required when an issuer experiences a material change, which is defined in securities law as a change in the business, operations, or capital of a reporting issuer that would reasonably be expected to have a significant effect on the market price or value of their securities, or a decision to implement such a change by the board of directors. For example, if a regulatory decision results in a shutdown of a material business segment or significantly alters previously disclosed plans for that segment, this could constitute a material change that would require more timely disclosure. In such a circumstance, an issuer would immediately be required to file a press release describing the change and file a material change report as soon as possible, but no later than 10 days after the change occurs.
Okay. Thanks, Jennifer. All right, and then let me see here. There's a question, just there's maybe some confusion about who is a related party. We talked about multilateral instrument 61-101 and the definition of related party there. There also is a reference to related party in IFRS. So I think it's just really, what's the difference, and when are you using the multilateral instrument 61-101 definition?
Yeah, I can take that one. Yeah, so multilateral instrument 61-101 includes a very detailed definition of what is considered a related party, whereas Form 51-102 F1, Management's Discussion and Analysis, for the disclosure requirements for transactions between related parties, it just refers to what is considered a related party as defined by the issuer's generally accepted accounting principles. So as you mentioned, for most issuers in Canada, that would be IFRS and IAS 24 related party disclosures, which is a more narrow definition of a person that's considered a related party to an entity. So when are you using one or the other? So if your disclosures are under the continuous disclosure requirements in 51-102, then you would be looking to that definition, the IFRS one. And if the transaction falls within 61-101, then you have to use that related party definition from there.
Okay, thank you. We have another question on the semi-annual reporting pilot, and it's just about timing. Nicole, are you able to comment on sort of when we think that might actually be effective and available?
Yeah, so the CSA, we're currently reviewing all of the comment letters that we received, and we are anticipating that we will be able to get something out for effectiveness of March 2026.
So potentially you would not, it might be out in time that you wouldn't actually have to file for that if you had a December 31 year end for that first quarter Is that right?
Yeah, we're currently reviewing things, but that's what we're anticipating.
Okay. All right. I think one question here for you, Vernon, and it's with respect to the MCTOs. I think just what is involved really in making that application. If somebody thinks they're not going to be able to file their financial statements on time and they want to apply for the management cease trade order instead of being subject to a full cease trade order, what sort of level of detail do they need to be putting in that application?
So in the application, which should be filed 2 weeks prior to the default, we would expect an application letter, signed consents from the CFO and the CEO, an undertaking, and then also we would require a default announcement to be filed on SEDAR+, of which we could also assist the issuer prior to that date in order to fill that in or to file that. So those are typically the forms that are required. If there was ever an issue, the issuer could always reach out to us too, because there are circumstances, as in the presentation, with certain things that may occur. There could be exceptional circumstances, a number of things that could occur. So basically, you could reach out to us as well, and our contact information, or my contact information, is there as well.
Okay. Do we have the contact info up on the screen right now? Mine doesn't show it. All right. Do we have any more questions? I am not seeing anything. Okay, I think that's it for questions. I messed up in my earlier remarks about our upcoming webinar on the Energy Matters report and the results of that. I think I said November 29th. It's next week, January 29th. So if you're interested in joining us for that, please sign up. There's been questions about the webinar and the slides. They're both going to be available on our website. So if you go to our website and click on the menu button up in the top right-hand corner, there's a major heading called, I think, News and Publications. And then below that is a subheading, Events and Presentations. So you'll, both the slide deck, which should be available today, should be up there. And then in the next week or so, we expect that the full webinar recording will be up there as well. And you can see the prior presentations on the website. Okay, so I think that's everything that we had to share today. We are providing our contact information. So if you do have any follow-up questions, if you do need to, want to reach out, please do so. Please connect with the team. And I think that's all. So thank you very much for joining us today. Have a great day.